I'm Senior Deputy Director of Supervisory Examinations and Policy in our Division of Risk Management Supervision, and I really appreciate your attention this morning. I just want to quickly go over a few ground rules before we get started here with our illustrious group. We're going to be recording this event as well and posting it on our FDIC Mutual webpage. This one's a little different than the event we had in the morning. We have a smaller group, so we can entertain live questions, but we do ask that you keep yourself muted and off camera if you're not asking a question, to limit the bandwidth issues and also to avoid distractions. We hope you're going to actively participate. Don't hesitate to ask some questions after the panelists have made their initial remarks. I've also got a set of questions as well, and we did receive some in the morning session that we'll try to return to. To ask a question, raise your hand by using the hand icon next to your name, and it's going to be in the upper right-hand corner. And then you can unmute your mic by using the microphone icon that's also next to your name or at the bottom of your screen once you are acknowledged. And if you don't see your name, go to the banner at the top of your screen and select participants, and then your name will appear at the top right of the screen. And it sounds like a lot of instructions. These are always a little bit different. Or if you'd like to ask a question, you could also just put your question in the chat box in the lower right of your screen. We're all going to be seeing the chat today. If you'd like to activate closed caption, click on the three dots in the lower right corner of your screen and then click on the button that says Multimedia Viewer. And if you would like to change how we appear on your screen, look near the top right for the layout icon and you could select a screen layout. So that's all our operational instructions today. I'm going to introduce our speakers now. I think you're going to be very excited to hear them. We also have regional representatives on from both supervision, risk management supervision, and compliance and consumer protection. Doreen Everly is our first speaker. She's the director of the Division of Risk Management Supervision. She's my boss. She leads our safety and soundness supervision group. We also do risk monitoring and policy development activities. She oversees a workforce of approximately 2,600 employees and has been doing this since February 2013. With us too is Mark Pierce, and Mark is the director of the Division of Depositor and Consumer Protection, and he leads our efforts to protect depositors and consumers nationwide. This division has responsibility for the FDIC's compliance and CRA examination and supervision for state non-member banks. They also do research and policy development related to consumers' use of financial products and services. He oversees community affairs, financial education, and economic inclusion efforts. And then the new guy, Sultan Meji, he's laughing. He's not so new anymore. He will try and pull the card on you, but don't let him do it. He was named the Chief Innovation Officer of the FDIC in February 2021. And prior to joining the FDIC, Sultan co-founded a company called Neocova, and this was a financial technology firm that provides secure, cloud-native, artificial intelligence-based software for community banks and credit unions. He's also served as an advisor to the Treasury, to the G7, the OCC, the FBI, all in the areas of cybersecurity, quantum computing, and AI. So he's got a very storied background. We're delighted to have him. So the format today is we're going to ask each of our panelists to make a few remarks, and then we'll have some questions, and we'll dig right into it. So, Doreen, why don't you start us off, and then we'll go to Mark and then Sultan.
Okay. All right. So, well, thank you. Thanks for the introduction, Rayanne, and I'm excited to be here. This session is always a lot of fun, and enjoy getting to engage with you in a smaller group. So I thought I'd recap our response to the pandemic over the last year, and then I'll talk a little bit about what we're seeing through our supervision program and what we're focused on in our supervision program to kind of wrap up my comments. So I'll start with the Friday. Friday, the declaration of the national emergency back March 13th of last year. we began telework the next Monday. FDIC was on a mandatory telework program. And one of the first actions we took was to issue a statement recognizing that the potential was there for COVID-19 to adversely affect the customers and operations of financial institutions. And so we encouraged banks to work with all of their borrowers. We did that right away that very first week. And then we paused our exam activities for a couple of weeks to give you time to respond to the changing conditions and take care of your operations, your employees, your customers. And it also gave us, during that 2-week period, an opportunity to get our arms around the situation. We asked our examiners to finish those exams that they could and to let us know if there were examinations that couldn't be completed without going back on site. And as it turned out, they were able to finish everything that was in process. So at the end of that 2-week period, we reached back out to bankers that had either exams that were in process, had gone through the planning and were about to start, or maybe we were just starting the planning, and we asked how they wanted to proceed. We still recognized that the situation was pretty new. People were still reacting to the sudden set of closures and making sure that they were able to serve their customers. And so we asked how you wanted to proceed. We wanted to give you time to adjust and, again, to take care of things. And most bankers wanted to proceed, and so we did. We offered one more 2-week round after that, and again, most bankers wanted to continue. And so we did as you requested. During this period, we also developed and issued instructions internally and externally for sending mail electronically to the FDIC and for us to send correspondence and reports of examination electronically back to you. So these were, ideas that were on our timeline, things we wanted to do that got greatly accelerated out of necessity, and really, I think, a positive thing to be able to communicate in that way instead of snail mail. And so the chairman mentioned this morning that we also issued guidance on prudent loan modifications. We used that period of time to work with the Financial Accounting Standards Board, or FASB, to confirm that short-term loan modifications, so those are less than 6 months, that were made on a good faith basis in response to COVID-19 to borrowers who were current prior to any relief, were not troubled debt restructurings. About a couple weeks after we did that, the CARES Act was enacted, and it expanded the TDR relief to a broader set of loan modifications. And then this relief got extended last December for another year. So all of this happened in the course of about a month. And by mid-April, we had moved completely to an off-site examination model. We were able to execute our exam program last year. We conducted all examinations required by statute. We did it all off-site. And I think it's important, there was some discussion earlier today. The chairman talked about innovation, and other groups did as well. And truly, the prior actions we had taken allowed us to make this pivot really quickly. Back in 2018, we started piloting our own file image viewer for examiners to be able to gather your imaged loan files in a standardized way and review loan files off-site. We also piloted using WebEx to be able to look into your loan systems and look at imaged loan files. So 2 ways that we could conduct loan review in an off-site fashion. And then in January of 2019, we started piloting the use of Microsoft Teams to have a collaborative environment for examination teams that may be working in multiple locations. We hadn't envisioned it for a completely off-site examination, but we were envisioning it where we had larger institutions and we had examination groups in multiple states. So those efforts were born out of a desire to leverage technology to complete additional exam work off-site. And our goal was to reduce banker burden and also to reduce examiner travel for work-life balance for our staff. And we had been on this track for some time. We'd increased our off-site, the percentage of our exam hours completed off-site from about 34% in mid-2016 when we really headed in this direction with intention, to up to 47% at year-end 2019. And we do think that percentage is going to be higher in a new normal. Don't know what it'll be, and we don't really intend to set a statistic for examiners to follow. We want our examiners to plan examinations, the examiners in charge to plan examinations, just like they did before the pandemic. but leveraging what we've learned over the last year plus to determine what can be done off-site, what needs to be done on-site, what's more appropriate for on-site. So we have developed a return to office plan and a companion return to bank plan. They each have 3 phases, with the third phase being the new normal. And we just entered phase 1 this week, so we've got a little bit of a ways to go. But in the first couple phases, any decisions to conduct exam activities on site are going to be on a case-by-case basis. The decisions will be made by FDIC senior management, so the regional directors will be making those decisions. And our on-site teams will be minimal, really small. Our goal longer term is to achieve a balance in what we do on-site and off-site, so finding the right mix of exam activities that'll promote efficient and effective risk-focused examinations. But I do want to emphasize that in the new normal, we are going to have an on-site presence at every examination, consistent with our obligations under Section 10D of the FDI Act, the Federal Deposit Insurance Act, which requires on-site full-scope examinations of all insured banks every 12 or 18 months. So, anecdotally, we've heard positive feedback and at the same time some comments that you look forward to us coming back on site for some portion of future exams, positive feedback about the off-site work that we've done over the last year plus. And I do hope that as we get into conversation a little bit later that you'll share your thoughts about how the off-site exam program has worked over the past year, including any best practices that you've encountered that you think we should incorporate into our new normal. We'd love to hear about that. So let me shift to what we saw from all of our supervisory efforts over the past year. Chairman McWilliams mentioned this morning that we were all pretty worried last April and May about how the economic disruption may play out. And, even though it came about and played out really very differently from that of 2008, we did make some initial comparisons to that period because that's the data we had. And in the 2008 crisis, unemployment peaked at 10% in October of 2009. That was about a year into the crisis. And failed banks peaked about 5 quarters later in March of 2011. And if you roll back to April of 2020, you'll remember that unemployment was either at 15% or 19%, depending upon the calculation. There was some disagreement about the metrics. But at any rate, it was at least 50% higher than the peak in the financial crisis of 2008. So we were ready. We were ready to initiate our contingency plans. Readiness is a good thing. But we ended up not having to execute because conditions did improve. The banking industry proved resilient and certainly aided in part by high levels of capital and liquidity going into this event and also by government stimulus programs. So at this point, we're just not really seeing any kind of material impact, adverse impacts from the pandemic for most institutions. For the first quarter of 2021, our problem bank list declined by 1 to 55. That's at a kind of historic low. People ask us what's the range, and it's the historic range is 1 to 2% of the industry, and so we're down just a little over the 1% level. And no banks failed in the first quarter. Asset quality issues among banks have been really limited thus far. Certainly the government relief helped, and certainly the modifications that you all entered into have helped. We've seen a steady decrease in the level of modified loans since the beginning of the pandemic. With every quarter, we've seen those numbers come down. And usually when customers need additional accommodations, it's limited to the hardest hit sectors, so hospitality, entertainment, or it's perhaps to, when we're seeing deterioration, it's with borrowers that were struggling before the pandemic. Internal credit rating downgrades, other than those that were struggling before, have been mainly limited to watch list or special mention. Haven't seen much migration to adverse classification. That's been pretty limited. And, we know that even with that, relatively positive news, you are all continuing to monitor performance as accommodations and eviction moratoriums and expanded unemployment benefits and stimulus run their course. And some of you are being a little bit more cautious with new loan growth, especially as we all seek to understand what changes may be temporary and what may be a paradigm shift. Changing work habits were already mentioned earlier today. And banks could be impacted by trickle-down effects, such as if the office sector deteriorates with expanded work from home. That's likely to be a little bit longer prospect, as leases are generally a little bit longer. But those are the things we're going to be looking for. Also, the accelerated shift from retail to online shopping in the pandemic, that was also mentioned earlier today, even our groceries. And so what does that mean for the longer term? So these are the things that we'll be watching. Some businesses have also experienced supply chain challenges or hiring challenges, and that could amplify some of the pressures that some of your borrowers are experiencing. So we're going to keep a steady eye on all of this, just like you are. That's not new. We've had a steady focus on commercial real estate since the 2008 financial crisis, and frankly, before it as well. And the frequency of our supervisory recommendations, including matters requiring board attention, has reduced over time because banks are really doing I would say, a better job with their risk management practices. The strength of risk management practices has grown over time, which is good. Really today, the primary topics that we see in supervisory recommendations, and again, at reduced levels than in the past, are board management and oversight. So maybe the board hasn't established program parameters or they're not regularly monitoring program results. Some stress testing and sensitivity analysis, maybe a little bit of a surprise here that we see it somewhat with banks that have higher levels of concentrations where you would expect stress testing and sensitivity analysis to be stronger. But, we're seeing some of those that really have insufficient efforts at stress testing. Sometimes they're nascent efforts at stress testing. And then portfolio management, so the policies, procedures, parameters, monitoring market conditions, all of those things. Like I said, everything's been pretty much coming down in terms of the volume of examinations or percentage of examinations that end up with supervisory recommendations or matters requiring board attention related to commercial real estate risk management practices. But we have seen a couple of slight upticks recently for market analysis and management information system recommendations. And, one thing that we've done recently that's just kind of an interesting thing is really thinking about what are the data points that banks are gathering on a regular basis, concentrated banks, that need to be monitoring and stress testing. And what are the kinds of data points that they don't have right now that would be really helpful to understand, changing values and concerns about, if you experienced loss rates of X percent on the portfolio, what would that mean for your capital? What do the impact of vacancies mean to net operating revenues, and how is that likely to change values? Those sorts of things. And we've seen that banks they're gathering this data now, but they're having to go back manually through files and do it. It hasn't been something that's been regular and automated. So, there may be some additional lessons learned relative to stress testing coming out of this period. Some other items that we're focused on, we've seen record low net interest margins associated with the extended low interest rate environment and record amounts of deposit growth. And these are both creating a challenging situation for many banks nationwide. And I should point out the records. These are the records that were set last year for both net interest margin lows and deposit growth highs are for the period of time that we've kept the data, which goes back to 1984. So those are pretty significant changes. So we're looking at earnings, liquidity, and capital. Those are all areas that we continue to monitor. As always, Bank Secrecy Act and information technology continue to warrant bank management attention. We've got some changes coming, statutory changes to the Bank Secrecy Act program that you'll be seeing more about over the second half of the year. As FinCEN adopts new national priorities that they're required to adopt under statute, and then the regulatory agencies follow on with changes to our program rules. And information technology, we just had a great panel with our IT specialists leadership talking about cybersecurity and how that really remains a heightened priority, just an area of truly increasing risk. I think the best thing that, we can do relative to all of these risks is make sure that we examine well and that we focus on the robustness of your risk management practices, make recommendations where they could be improved relative to the risk profile of the institution, From an IT perspective in particular in cybersecurity, our examiners take a look at your threat monitoring processes to make sure that you're adequately informing bank staff or that the process itself is giving you adequate information for bank staff, management, and your board. Threat monitoring programs should be using authoritative public and private sector sources of threat information. FSISAC is one that the agencies highlighted back in 2014. The FBI, DHS's Cybersecurity and Infrastructure Security Agency provides tremendous information. Treasury's Office of Cybersecurity and Critical Infrastructure Protection. Those are just a few. And these types of organizations are designed to disseminate threat and vulnerability information quickly and get you actionable information that you need, and most banks are taking advantage of this. We do provide information to our examiners on current threats, such as the SolarWinds breach and the Microsoft Exchange vulnerabilities. So they have context for their review of the threat monitoring process. And from time to time, you may get a call from a case manager or an examiner asking about, your actions taken in response to one of these vulnerabilities. So don't be surprised if that happens, but we are following up on those. And we are continuously reevaluating our public statements regarding IT risk and controls because of the state of changes and the rapid pace of change. We've been evaluating through the FFIEC, the Federal Financial Institutions Examination Council, our public statements regarding authentication, so how your employees, customers, and external systems identify themselves to gain access to a bank system. You heard Kevin Allard allude to that when he talked about corporate account takeovers. How are they getting in? We're likely to take a stronger position on the need for multi-factor authentication given today's threats and the improvements in authentication technology. So more to come here. And I think, there's probably some opportunities here to partner on the public-private standard setting process that the FDIC has been exploring. Chairman McWilliams mentioned this proposal this morning, and I'm going to save it for Sultan to speak about it in further detail. But that may be a way that we can provide some assistance on the vendor due diligence front as institutions seek to, balance innovation in a safe way without increasing cybersecurity risk. So I think one other area that transcends a few CAMELS components is the LIBOR transition. We're continuing to assess institutions' plans to adopt a replacement rate and to stop issuing new LIBOR contracts before the end of this year. And I can share that FDIC supervised institutions are generally on target to meet this goal, so that's good. Most FDIC supervised institutions don't have material LIBOR exposure, and those that do tend to be banks that are larger, usually more than $10 billion. And then some of the larger community banks that engage in commercial lending or derivative activities. From a supervisory perspective, we're focused on the bank's selection of a replacement rate, that they've got something in mind and they're moving down that path, that they're focused on appropriate fallback language for legacy contracts to avoid litigation risks down the road and consumer harm. The technology capabilities for processing a new benchmark rate, is it going to fit into the institution's IT capabilities, into its systems? How they're communicating with customers and how they're protecting customers and focused on protecting customers. So we're remaining watchful of the progress that's being made on this front, given the legal, operational, and consumer compliance risks. And we'll continue to talk with institutions about their LIBOR transition readiness as the cessation date approaches and on into 2022. So I think I've mentioned all of the CAMELS components as an area of focus, except maybe management. And I don't want you to feel left out. We do continue to focus on management, of course. But I will share our observation through this period that bank management has done a really good job managing through a very difficult period. So let me end by sharing some kudos for your work over the past year and to thank you. Rayanne?
Thank you very much, Doreen. So you can tell there's nothing going on in our division at all. So I'll turn it over to Mark to just give a few remarks about what's going on in DCP.
Great, Rayanne. Thanks so much, and thanks for having me today. I'll keep my remarks brief. Doreen covered a lot of the waterfront from an operational perspective and sort of going through the last 15 months in the pandemic, and really one of the best parts of these kinds of engagements is the questions and answers, so look forward to that. But I do want to cover a few points, and I'd probably start where Doreen ended her remarks, which is really just a thank you for all the actions you've done over the last 15 months to serve your customers, consumers, and small businesses. Obviously, when the pandemic hit, we were all making transitions, as Doreen talked about. And I really, from my observation and from those of my team, it really has been remarkable how bankers have stepped up to support customers throughout the pandemic. We could talk about PPP loans. We could talk about access to stimulus payments, the work that you've done in your branch lobbies to ensure you could give people access to the branch services, by appointments, or, all the safety considerations there, drive-through tellers, forbearances and loan workouts in the mortgage market in particular, and in other loan products, waivers of certain fees that were happening for consumers to help them sort of do what we were all trying to do, is manage through the pandemic. And you were doing all those things while managing the safety of your workforce and the operational challenges that were caused by the pandemic. So, I do want to echo Doreen's compliments and just appreciation, because I think the work that the banking industry and mutual banks did really helped provide support to consumers during a really difficult and challenging time. Turning to the consumer compliance picture related to that, I'd say coming into the pandemic, mutual banks were in a strong position from a consumer compliance perspective. I've been in this role for 10 years now, and the consumer compliance ratings are as high now as they've ever been. Close to 90, it's in the upper 90% of banks manage their consumer compliance programs effectively. And the good news is that, when we conducted exams during the pandemic, we found that banks have been able to maintain that attention to the consumer compliance issues, even as they're dealing with the challenges of their customers and challenges of their operations during the pandemic. So I really want to, maybe doubly appreciate the attention to the basic management pieces of the compliance management program with everything else going on. I frankly, having gone through the last crisis and the consumer impacts and related to that, I was anticipating some significant challenges that would pop up as consumers struggle to make their loan payments and calling into banks and servicers of loans to get workouts and modifications and things like that. But frankly, we really just didn't see that. And, Doreen talked some about government relief and government stimulus payments may have helped in that process. But I also think banks were much better prepared and attentive to meeting the needs of customers, whether it's forbearance or workouts. When we've looked at, consumer complaint activity, I was expecting a spike. We didn't really see it. When I think about, we took a look at some of the larger banks that we supervise that have significant mortgage portfolios to see how they were managing the implementation of the CARES Act, mortgage forbearance, and some of the credit reporting pauses there. And, overall, the picture was pretty positive from our diagnostic review of those institutions, that they seem to have good plans in place and putting people in processes to manage, the new programs that were rolling out, at a time that they were trying to maintain the existing operations of the bank. Looking ahead, I guess, this is my second day back in the office in the last 15 months. I've been working from my bedroom or basement for, kitchen, porch, over the last 15 months. And, as I think we're all kind of hoping to get back to some semblance of normal, the thing that I'm really watching is the consumer performance metrics and consumer financial health. As we've talked about, consumers have, some consumers in particular benefited from government relief payments or stimulus payments, unemployment payments, foreclosure moratorium, eviction moratorium, and other loan relief. As those programs start to wind down, over the rest of this year in particular, I think we'll get a better sense of what the true picture for the consumer in small business financial health is going to be. And obviously, you guys are going to be paying close attention to that as well, and to see how that affects loan performance. And so that's something that I think we'll all be looking at it as we move through the second half of this year. On the regulatory side, sort of non-pandemic related, we've got flood insurance Q's and A's that we've been working on an interagency basis for a year plus now. Our hope is to finalize those in the second half of this year. Earlier this year, we issued a request for information on deposit insurance, signage, and advertising to look at ways to modernize some of those requirements that we've had in place for a long period of time. Doreen mentioned some of the work that we're doing with Sultan in his new role, and welcome to Sultan. You're still the new guy. It's, I guess, been 4 months or something like that. I managed to maintain the new guy card for like 8 years, but eventually it does go away. But we've been partnering with Sultan and his group on a number of tech-specific initiatives. In fact, Sultan was speaking at an event that we were having earlier today on fintech as a bridge to economic inclusion. And maybe that's a place where I want to maybe one last thing I want to talk about is something the chairman has a personal commitment to, and the agency's had a commitment to for a while now, and that's really related to bringing people into the banking system and ensuring that the banking system is working for them. We really have, we've done research on bank participation by consumers, and we have a situation where more consumers and a greater percentage of the population are banked than ever before. And so we've made a lot of great progress, but there's still some a way to go, and Sultan talks about the last mile, and maybe he'll talk about that in his remarks. But thinking about the experience we've had over the pandemic, and one just insight into how important it is to be part of the banking system is thinking about the government relief payments, the stimulus payments that we've been talking about. If you had direct deposit and you had your bank account information on file with the IRS, your money was direct deposited into your account and you had access to those funds quickly. If you did not have a bank account or didn't have that information on file with the IRS, then you had a window of opportunity where maybe you could put it in, but if you didn't have a bank account, what happened is you were going to receive your stimulus payments or relief payments weeks or a month later than everyone else. So in the middle of a pandemic, when folks that have the least connection to the financial system probably needed the money the most, they had to wait the longest to be able to access it. And it's because they didn't have a bank account, right? That it's not something I'd really thought about prior to the pandemic. There are lots of other reasons why it's great for folks to have a relationship with a financial institution. But that just really highlighted just another aspect of why participating in the banking system can add such value to consumers. And for those, when they got the paper check, then they had to go find a place to put it, right? So they had to go find a check casher in a physical location that would cash a check. And so even aside from the fees that may be charged for accessing government payments, that folks who had direct deposit didn't have to incur, you also had the health and safety risk of going out and finding a way to get access to your funds. So lots of just sort of a window into the importance of reaching as many people as we can and bringing them into a positive relationship with a financial institution. So one of the things that, as a result and as part of our ongoing program, we've been doing a lot to continue to get the word out. We have a campaign called #GetBanked. You can come to our website. It's got some materials and resources for consumers about the benefits of a banking account and some of the questions they might want to ask, and to try to find an account that will work best for them. And so we're going to, we've been doing a lot of work on that area, and we're going to continue doing a lot of that work. And I know Sultan's got some great new ideas to bring to expand our opportunities to make a greater impact. And maybe that's a good place to stop and turn it over to him.
Thank you very much, Mark. Hey, I wanted to just remind folks before we turn to Sultan, if you have a question, please, you can enter it into the chat for everyone, or click onto your name and you can raise a hand, and we're happy to chat with you. So Sultan, let me turn it over to you for some remarks, and then we'll certainly go to questions. Thanks.
Fantastic. Thank you, Rayanne, and thank you, Mark and Doreen, for the kind words. I feel like between the two of them, they covered so much of what I want to say that I'll be able to kind of fly through this very quickly. But I will start by complimenting everyone here. I think, comparing 2008 to what we've gone through over the last few years, it's not exactly apples to apples, but if you look at how the banking system rallied, whether it was some banks working multiple shifts in order to support PPP loans to, navigating this new environment, it's just an incredibly positive outcome in terms of that. And I think it's great for us, on this side of the FDIC wall to be able to see that in terms of the strength of performance, lack of failures, et cetera, et cetera. And so, that's a great time for me to enter the organization. And Mark nailed it. I've been here almost exactly 4 months, after roughly 30 years in tech in the private sector. So I come to this with a slightly different perspective. But allow me to say that in the face of all that's happened over the last few years, at the same time, we're seeing such tremendous changes in technology, tremendous changes in what the end users, be they consumers or small, mid-sized, or larger businesses, are looking for from the sector. To see this increase in evolution to support that is really quite positive as well. I'll just say that, across the FDIC's innovation program that actually predates me, I'll talk about a few things that we've done and a few things we're doing, and then highlight some of the areas we will be going. So on the front end, Doreen and Mark covered very nicely the standard setting organization discussion, and we're very excited for that to come. But basically, it's a way of looking at opportunities where there can be some efficiency around standards. So instead of newer and other third-party service providers having to kind of recreate the wheel every time they talk to one of you, the idea is maybe they could do it once, and then it's available to everyone. And that just simplifies some of the due diligence requirements, and also allows us to keep a little bit of a closer hand so that Doreen's team and Rayanne's teams can go about their lives in a more efficient way. One of the themes of innovation that we're working on here, we have a bunch of them, but one of them is about amplification, and it's about removing arduous friction from the process. So don't do it 4 times, don't have people manually typing things at keyboards, et cetera, et cetera. One of the things we've done here very recently is expanded the use of online collaboration technologies to the point where, whatever you do on your laptop, you can do on your tablet, you can do on your phone. And if we can extend that philosophy out to the banking sector, it's a really valuable opportunity for us. And so you'll see some more around that, but the standard setting organization is one piece of that. The other thing that we did last year, in the midst of a pandemic, by the way, is our rapid phase prototyping project, which, if you look at it as strictly a procurement exercise, it's a light speed compared to what you normally see from federal agencies. Announced in the summer. By the time you got into the fall, people, we had these 30 or so agencies, organizations lined up, executing through, and by the time you get to March, we've gone through the whole multi-phase process, and I think there were about 11 companies that got through the back end of that first part of it. It's absolutely fantastic, some amazingly creative work, and we've got more to talk about there in the future, but it's some really great activities. One of the other themes, and both Mark and Doreen highlighted this, was around inclusion. And just a few weeks ago, we announced our first tech sprint around inclusion. It's all about the last mile. And I break that up into really 2 discussions. One is, how can we get creative ideas and champion creative ideas about how to close that last mile gap for consumers? Because we have far too many Americans who don't have great access to the banking system. The numbers, I won't repeat what Dorian and Mark said, but in the back of my mind, there's this number that says there are tens of millions of Americans without bank accounts. And that just, I find that kind of personally offensive. In this day and age, you have to. And I don't care if you go into a bank branch or you're doing it from your mobile phone or anything in between, right? The technologies can enable that. We don't want to be in a situation where we have haves and have-nots in the banking system that's mirrored by have and have-not on the digital side. That just got announced. Applications are going to be open for that here very shortly, and we're looking for people like everyone listening to the sound of my voice to think of creative and cool ideas of something they've done that they want us to see and champion. So we're really excited about that. And we're going to do a couple more tech sprints here in the future in other areas. One of the other themes that's critically important, and Doreen did a great job of highlighting, and the previous session talked about, was on the cybersecurity side. And for us, we call that resilience. And resilience is about not just being able to take a punch, but knowing that you're going to get punched and knowing how you're going to respond after you get punched. And that's a big deal in the world where, you can rent a ransomware service for $50. It's no longer just a guy digging through your trash, or war driving, which is when you drive by your house and try to hack your Wi-Fi, which is, I'm dating myself by calling it that probably, but, we have to get past all of that and think about resilience across the overall sector, whether that's how we manage changes in the workforce because of people, maybe or maybe not going back into the office the same way they used to, through to different processes as we go through and look at the evolution of what FinCEN is doing or other operational processes, all the way through to the technologies, because the technologies are changing rather rapidly, and that pace of change is increasing more and more. There are still many hundreds of institutions out there that don't have mobile apps. And that's great. That's their choice. But mobile first is the name of the game and going forward as it relates to technology. More people use mobile banking technology than traditional online banking technologies. And so we have to work around how we make that resilient and ensure that whether it's an attack from a criminal gang using ransomware or a tornado or a flood, we have to make sure that we're thinking about how to deal with that. There are other technologies that have entered the market, like artificial intelligence, that we have to continue to think very critically about. And obviously, we're not going to go deep into a conversation about AI in a forum like this. But I will say, you might not realize it, but you're probably already using artificial intelligence, even if you don't realize it. And the example I give is, take your phone. Are you using a fingerprint reader or a facial recognition technology to unlock your phone? Well, you're using artificial intelligence. And that's an important thing to consider as you go down the path of acquiring new technologies, is that you might not necessarily be confronted directly by the use of some of them, but they are there. And so having really robust change management methodologies in place that are aligned to organizational best practices is really rather critical. I was really excited that Dorian talked about multi-factor authentication, because that was one of the very first things I started talking about when I landed, and it's really exciting to see those discussions moving forward. The other piece of technology that's coming, and I'll lay a little bit of a breadcrumb, is quantum computing. Quantum computing, I'm not going to go into any significant detail on this. Don't worry, nobody has to take some Advil when they listen to me talk about this. But quantum computing is fundamentally a logarithmic step change in the performance of computers. So if your computer is performing at X, now it's all of a sudden performing at an order of magnitude, about 10X, 100X, 1000X. And one of the biggest side effects of that we're going to be presented with as an industry is the ability for quantum computers to break current encryption standards. And that is coming. NIST, the National Institute of Standards and Technology, will have a new set of encryption standards. So they manage the encryption standards for us. We're using a certain set today. In 2024, a new set will be available, and we'll all need to move on to that fairly quickly once that's available. And so that's something that everybody should have on their radar. And so I like getting people out of a reactive mode and into a proactive mode. So let's plan for 2024. Let's get ourselves ready to know that those changes are going to be coming. That's a big deal. It's one of the bigger changes. A lot of people compare this change to Y2K. I don't know if I would necessarily go that far, but you're in that order of magnitude in terms of change, and it'll have lots of little ripple effects. And so this is the time when you can get your staff organized correctly, your change management processes organized correctly. So that's not a very innovative thing to talk about, but it's where I will end this part of the conversation and turn it back over to Rayanne. And just to say that I'm very happy to be here. I'm excited to engage with all of you. I look forward to the questions, look forward to doing this many times in the future as well. And never hesitate to reach out. There are a lot of things going on here, and we don't have time today to cover all of them. And I look forward to finding new and interesting ways to engage in all of you in the future. And with that, I'll turn it back to Rayanne.
Thanks very much, Sultan. And as a reminder, please enter your questions in the chat, or you can raise your hand by clicking on your name. And I think the first question that's come in is for you, Sultan, and it really dovetails into your last point there. In the first session, our moderator of the chairman and acting comptroller panel really talked about nothing too techy in her innovation, just asking her customers what they want. And the chairman talked about our Amish-focused institution that has the Gelt bus. And so that's an innovation for them, and that's something to give customers what they want. But we can't sort of rest on our laurels and not realize that there are competitors out there. And so the question relates to fintechs and competition, particularly on the deposit side of the balance sheet. And we see apps and neobanks, chipping away at the customer wallet. And the question here is, how do you see community banks in particular staying competitive in the face of these types of competitors in terms of partnerships, launching their own, or any other strategies that you can observe for the smaller institutions?
Oh, it's a great question, and it's a critically important component, right? If you go back and you look at the 20th century, community banks were the best at knowing their customers, right? They were on Main Street, they were talking to people. The people who worked in the banks had lunch at the diner. I mean, this is small town America. This is where I grew up in the middle of Illinois in a cornfield. So this is exactly where they are. And this notion that that isn't still a strength is something I want to push out of this. That is still an absolute strength. It's just in the way you do it is evolving. It's not just, sitting across the table from someone. Maybe it's being part of an affinity group on social media. Maybe it's, a variety of other digital methodologies there. Fintechs have done an excellent job, and as a market observer, I feel comfortable saying this, over the last 10 years or so, meeting customers where they are and providing low-friction environments for them to engage, apps being, one of the best examples of that. Community banks, for the most part, actually understand their customers better than the fintechs do. The fintechs, generally speaking, kind of throw stuff at the wall very cheaply, 5 guys sitting in a room hacking away at something, and that they can do it really cheap, kind of cheap and cheerful, right? Community banks, I think, are far better positioned to really understand their community and say, hey, listen, in this zip code, we don't have quite the same depository growth that we have in this other zip code. Why is that? And there are good bankers in that organization that can really understand that. Can then banks figure out how to attack that? Yes, absolutely. In some cases, it'll be the same way they've always done it. And in other cases, the same ways they've always done it. And in other ways, it'll be using new technologies. And this is where finding partnerships is a great first step, whether it's with other institutions to work together on common solution sets, or working with fintechs, or finding other technology providers. There's a lot of activity out there. There's, roughly speaking, 10 times as many fintechs in the United States as there are community banks right now. And so the issue is not finding them, it's finding the ones that are kind of mature and disciplined and sit well inside of a regulatory construct. I call it being regulatory forward. And they're, it's a much smaller group, but you're still going to find a lot of great opportunities there.
Thanks very much, Sultan. I appreciate that. I think the next question is an examination type question that Marianne Hathaway was going to read that came in through the chat.
All right, thanks, Rayanne. So this is a question that came in during the Chairman and Comptroller's panel earlier, so I'll just read it. It says, during the last low interest rate environment, then Chairman Gruenberg instructed well-capitalized banks to primarily address interest rate risk, and that earnings could be secondary, and that the agency would tolerate even negative earnings. So the question was, has that view changed, and can earnings still be sacrificed for interest rate risk purposes? And I think it's safe to say that any time that you have a risk mitigation strategy available to you, that you are going to be doing that at some sacrifice to earnings. The risk return model is still alive and well. And anytime we do look at earnings, we are looking at earnings relative to your individual risk profile. So a lot of you being mutual institutions, you are by nature more conservative just because you can't go to the market and raise capital should trouble arise. And so you tend to run maybe a more conservative organization, and because of that, you tend to have lower returns. And so, earnings that are satisfactory for, say, a mutual institution may be weak or even poor. Even if numerically they're the same, they may be weak or poor in consideration if the institution is much higher risk than often our mutuals are. And since Chairman Gruenberg had said this statement that, if you've got a lot of interest rate risk on your books, then you may need to manage that in a more conservative way. And sure, that's going to be an offset to your earnings. And maybe even while you're restructuring your balance sheet, it may be a short-term hit to your earnings, could cause them to go negative. But what examiners would do when they go to your institution is look at what steps you're taking in the context of your risk profile. And if it's a strategic decision you're making to on the short-term sacrifice earnings for that long-term benefit of reducing risk, absolutely. And for any of you who have had an exam in recent months, you may have had examiners talk to you about tightening net interest margins. A lot of you might have taken significant provisions to your loan loss reserve that you weren't otherwise expecting. And for many of you, that did result in very low or even possibly negative earnings. And there's a decent chance we might have still rated those earnings as satisfactory. Because again, these one-time issues or one-time changes to your balance sheet are putting that pressure on. But what we always want to do is focus on what's your core earnings, your core ability to be profitable, core ability to pay for overhead and other expenses, provide for capital. And then after you've done that, we look at that core earnings relative to the overall risk profile of the institution. So I'd say that the chairman's prior statements would hold true today, even though we're talking about very different examples and very different one-time impacts to earnings that we've seen, particularly over this past year. So I hope that answers the question. And if there's any clarification you need, feel free to put that in the chat. Thanks, Rayanne.
Thanks very much, Marianne. I appreciate it. So the next question goes to Mark. And Mark, we touched on this again. I know you had a conflict, but in the morning we were talking a little bit about, will customers come back? And one thing that sets mutuals really apart from their competitors is their knowledge of their customer. Their customers like dealing with bank employees, as one of the bankers mentioned. They do have a lot of CD owners. They do have mortgage borrowers, and those kinds of transactions traditionally have been done in person, and people like to talk with bankers about their money. So, the question for you, and I guess Sultan and Doreen, if you have anything to add to this, is, how do you see branch banking post-pandemic? Do you see the foot traffic coming back, and what are the pros and cons, if you will, of moving into a more digital delivery methodology?
Yeah, it's a great question, and let's see how long do you have? I think probably the way maybe the simplest way I would describe this is I'd call it yes and, right? I think that banks have branches, and that those branches have been very valuable for them to interact with their customers and build their brand and serve their customers. And I don't think that's going to go away. I mean, I think if you look at the data from our most recent survey of consumers back in 2019, like 80% of the people went into a branch during the course of the year. Even people who primarily use mobile technology, like Sultan talked about, there's still a significant percentage that use the bank branch 5 or 10 times or more a year. So I think the branch banking demise is not, maybe overstated. But I also think Sultan, when he talked earlier, was right on point that if you're just branches, right, you're probably going to miss segments of your market and erode your market share over time. So you really got to be able to do both, interact in person in branches, and I think be able to reach your customers and interact with your customers, whether it's by mobile apps or by chat or website, all of those things, and they're going to keep changing, right? And so I think that presents some challenges, but I think one in which I think mutual banks and community banks in general are going to need to address. I do think we are seeing banks take a look at their branch footprint, and not just the numbers of branches or where they're located, but what do you want to get out of a branch, right? Do you need lots of room for teller lines, or do you need more space to have consultations with a customer about their financial picture overall, right? And so I think we're going through a pretty interesting time with innovation, not just on the technology side with the mobile app piece, but really thinking about what the branches are useful for in serving the customers. And so I think it's really an interesting time, and I'll maybe turn it over to Sultan or Doreen to disagree with me or.
Well, I'm certainly not going to disagree with you, Mark, because you just agreed with me, so I feel like I need to now also agree with you. But I will say, it's interesting. You go back a few decades, and it was branch banking only, and then telephone banking started to merge in, right? And we had this whole conversation about telephone banking, and then it became web, and now mobile, and now chat. By the way, Mark, that's awesome. Chat banking. I haven't heard about a chat-only bank yet. I'm waiting. I'm sure some de novo will get filed for that at some point. But these are all augmenting, right? The landscape is the same, right? We have more money in the banking system than we ever have, right? And it's just you have all these different opportunities. And there are some institutions that will survive and, in fact, thrive on a strictly branch model. I'm sure of that. But just like that, there will be banks that will move to an entirely digital model one way or another and will thrive and thrive really rather powerfully, I'm sure, over that. And there'll be some movement in that space, right? There isn't a single right answer here. And that's the thing that I think a lot of people, especially who aren't in the banking system, don't really get, is that there's unique features to banks. It's not always the exact same mousetrap, and there are unique features, whether it's the institution itself or how they deliver, the community they're in, or their product and service set. And there can be amazing innovation on the product and service side that we haven't even really talked about here that I think is still a great opportunity. The Get Banked initiative highlights one example of that. But I think there's going to be a lot of that. So I like to say augmenting all of these different methods, whether it's a branch all the way through Mark's chatbot-based bank, which I'm now going to trademark that for him, is each one of those is an augmenting the opportunities for an institution to be successful.
Thank you very much, Sultan.
So I'm going to agree, Rayanne, take a minute to agree with the yes and. And I think one of the things that's so important, and it's been said earlier today, but I think it bears repeating, is that, the strength of community banks is serving as an economic engine in their local community, and that's even more true for the subset of community banks that are mutuals. And the relationships that are developed with customers, and those relationships are typically developed face-to-face. And I hearkened back a little bit. It's been several years, but we had a little informal study of millennials who happened to be employed by us as interns one summer, and we talked to them about what was important to them about banking. And it was fascinating. While they all, while they were away at college, needed to have access to money, so ATMs and mobile banking were very important, and having access to that stuff at a reasonable cost, they talked about getting birthday cards from their community bank. They talked about banking at the bank that their mom and dad took them to open their first account. And they talked about, when it came time for a big financial decision like their first mortgage, they wanted to sit across the table face-to-face to somebody that they knew had their back. And, so I think that's just a true strength of community banking and mutual banks in particular, that will mean that you need to have some branching. That'll mean branches are still important as part of that business model. I totally agree with Sultan. It depends on the business model. There are digital-only banks, and they offer different kinds of products and services. So just wanted to weigh in on the yes and.
Thanks very much, Doreen. I do remember that conversation well, and I remember one of these college students was sort of a contrarian and preferred to always go into the bank to conduct transactions, which might surprise some people, but there are even among different cohorts preferences, for various reasons. So the next question is another exam question, Doreen. I'm going to direct this one at you. How will the FDIC look at a bank's Tier 1 capital that may have been substantially compressed as a result of the extraordinary deposit growth, particularly when risk-based capital ratios rose significantly at the same time?
Thanks, Rayanne. So I think the first answer to a question like this has to be case-by-case basis. I can't give a specific answer because it's just going to depend on the institution. But generally speaking, I would say for those banks that have experienced substantial deposit inflows, and that's probably everybody on the call, it certainly is the case for the industry in the aggregate, that we've seen substantial deposit inflows over $3 trillion. Examiners are going to be looking at how you're employing the funds, how you're determining your true liquidity position, absent stimulus money, making sure that true core liquidity is still sufficient. Evaluating the adequacy of capital in light of the reason for the decrease in the leverage ratio, and I think that's what you're suggesting, that the leverage ratio has compressed, gone down, and risk-based ratios have increased because highly liquid assets have become a greater proportion of assets. Examiners are going to want to understand how you're viewing the deposits. How long do you think they're going to be on your balance sheet? How are you planning for eventual withdrawal? How are you managing that temporary mix? And what impact is it having on your business model? Are you making any changes in light of this temporary influx? Those are the kinds of questions examiners are going to ask. If the question is there, a rule that we're saying downgrade in these situations? We're not saying anything like that. And I'd kind of go back to a principle of the Uniform Financial Institutions Rating System, which really relates to the question that Marianne answered earlier as well, which is that it allows for ratings to be reflective of a given bank's size and sophistication, the nature and complexity of their assets, and their risk profile. It doesn't talk about peer, and so you're not graded against peer. It's against the bank's own size, sophistication, nature and complexity of activities, and risk profile. And we shorthand that in FDIC in our supervision program, and starting with our examination planning work to, what's the bank's business model, risk profile, and complexity. So those are always going to be the starting point for examiners as they look at these questions, and they're going to come back and ask how you're managing this situation. I think I'd maybe also refer you to the July of 2020 examiner instructions that we issued, our instructions to examiners for examining banks impacted by a pandemic. Really the starting point there too is to look at how is bank management changing its strategies in reaction to the hand that you've been dealt. How are you dealing with it? And does the way you're dealing with it make sense? So that's really the starting point.
Thanks very much, Doreen. I have a follow-up question from your remarks earlier about off-site exams and, the portion of the exams that are conducted off-site, for both you and for Mark. We're going to strive to do and to leverage the lessons that we learned during the pandemic and to conduct more activities off-site if possible. What activities do you anticipate will be conducted on-site in both the risk management and the consumer compliance areas? So maybe, Doreen, I'll turn it to you first, and then we'll go to Mark.
Sure. We actually went into the pandemic. We started changing our examination program. I talked about this earlier, starting in 2016. And in 2018, we issued new instructions to our examiners for planning an examination. We were a little bit behind Mark and the DCP side of the house, the consumer protection side, in implementing these changes. But we moved the planning further in advance of the examination to make sure that the examiner had plenty of time to really get to know the institution, understand, based on the last examination and the data we had between examinations from offsite monitoring from the case manager, what is the bank's business model risk profile, meaning how do its risk management practices relate back to its business model? Are they strong? Are they weak? Were there problems? Was it really good? And what's the complexity of the institution? To understand all of those things before developing a request list and determining what kinds of things do we need to examine at this examination, what are the procedures we need to perform at this examination, because they're not the same procedures at every bank. And to then think about, should these procedures, do they lend themselves to on-site or do they lend themselves to off-site? And then figuring out from staffing who's going where, what we're doing, communicating all of that with bank management ahead of time. And so we kicked off, Rayanne will have to help me remember when we kicked it off. Was it early 2019, Rayanne?
Yeah.
Yeah, January 2019 is when we went into full effect. I think we implemented it in October of 2018, and so the lead time for planning was examinations starting in January of 2019. And we had a bunch of banker meetings over the course of 2019, and we heard really positive comments. Bankers noticed the change. Several said that they were a little alarmed at first that, they were going to have some examiners that weren't on site at the exam, or that examiners may be coming or going, and that we started earlier. But in the end, the comments we got were very positive, that it reduced the on-site portion. It made the on-site portion more focused. While the examiners were there, important stuff was happening that needed to happen on-site. We weren't just taking up space and doing work that could be done elsewhere. And a real appreciation for it, I think. So when we put all of this out, we did tell our examiners there were some activities that we would always expect be conducted on site. And that's things like, having in-depth discussions with management. We want to do that face-to-face. We haven't been able to the last year, but we were eager to return to that. Observing and assessing an institution's operations and internal controls. That is best done when you're on premise. Collecting follow-up documentation to complete financial analyses. There's a lot of stuff we can do off-site, but you may need to have some follow-up information. You have follow-up questions, verifying financial information. Those sorts of things are best done on-site. And then, there may be some documents that would be inappropriate or impractical to provide off-site. Maybe your board minutes, maybe something else. And then, of course, conducting exit meetings with management and the board. Again, we think those are best done in an on-site fashion.
Thank you. And Mark, I think you got kicked off for a minute there, but you're back. I don't know if you have anything to add. A lot of the concepts would probably be.
Yeah. I mean, the great thing about coming into the office where you have a direct connection to the internet is that you are certain that you're then going to get booted off of your web video. So sorry for missing part of Doreen's answer, but I caught the tail end of it, which I really think on the consumer side hits the mark of, it's really the interaction with bank management at all parts of the examination that's really key, that can happen on site. As Doreen had mentioned earlier in the remarks, we had made a push to update our pre-exam planning program so that we could do more off-site work and have a more risk-focused examination where we really, examiners walk in and they kind of know the specific things that they're there for, and they do the things on-site that they need to do. And then, after that piece is done, they can go back and work on the exam report and other pieces off-site again. So off-site to on-site to off-site. So coming into the pandemic, we were about 2/3 of our exam activity was off-site. And, then everyone had to go to 100%, and I think it's probably somewhere in between as to what the, and so what, we're currently engaged in a process with you, Rayanne, and Doreen, and others to take a look at what kind of lessons did we learn from the pandemic, and which pieces are really best suited for on-site, and which ones can we now do off-site. We have better technology than we had 15 months ago, and we've got greater capabilities in using it. So there's some things that maybe we would have leaned to doing on-site in the past that we really have gotten more comfortable doing off-site. But being off-site does pose some challenges. And I think, one of the things that, I hear from examiners is where you used to have, and I hear from bankers as well, right? You used to have these informal interactions and engagements, and now it's more scheduling meetings, and it feels a little different than it would if folks were at the bank. And so, we're all going to be kind of feeling our way through this, and I'd like to tell you I had all the answers, but I think some of it is sort of thinking through the process and then testing out different models and see which pieces stick and which ones don't.
Thanks very much. I think the short answer is we're trying to leverage what we've learned, and banks can expect, including mutual banks, to see probably less presence when we go back to our full scope exam. So that's really good. So I have a question. I think I'm going to start with Sultan. We've got about 5 minutes left, and if we have time, move on to Doreen and Mark for their views on this. But Sultan, recently, Treasury's FinCEN department suggested that even banks with no intention of expanding their businesses into cryptocurrency need to understand the space and monitor their customers' interactions with it in order to fulfill their regulatory obligations. Mutuals are not known to be engaged in this space in an extensive way. What kind of advice would you agree with this statement, and what kind of advice would you give them, and where could they look for resources and information?
Oh, such a good question, Ryan. And this will take the full 5 minutes. So Doreen and Mark can relax. No, so I mean, there are kind of two halves to this discussion. Well, I guess three, right? One is I think it's just reasonable for anyone to be kind of paying attention to what's going on in the market, even if it's an ancillary thing, right? And it takes up a lot of air in the regulatory community currently. There are just a lot of things going on in this space, and I think if I would want to keep an eye on it, because even if they don't want to do anything about it, this is what splits into the other two. The first is some of that technology will conceivably land inside of these institutions over the coming years. A lot of the underlying, what we call Web 3.0 technologies are best represented currently within the technologies that sit behind crypto. And so while they might be using it for crypto today, it might be a reasonable thing to replace a database within a few years or something like that. The other half of that is we're starting to see organizations use crypto and crypto-based technologies to then become underwriters or other capabilities inside of the market. And we're starting to see that activity start to bubble around, and kind of the first generation of companies that are going to want to reach out to people listening to the sound of my voice and offer a variety of different white label products and services, or a variety of other things that have crypto in the background there. That's going to begin to come more and more. And so I think, again, it's about being educated about what's going on in the market. I think I don't know if I 100% agree with FinCEN, because I think everybody has kind of a box they need to operate inside of, and I would say that if I was sitting at the C-level or a board of one of these institutions, I would absolutely want to know what's going on, and also want to know what the exposure is, because I think about it like this. Like, I grew up with a community bank checking account with that little FDIC logo, and I knew that it was insured by the full faith and credit of the government of the United States, right? That is not the same of a lot of the mobile apps out there. That is certainly not true of crypto. And there is, I worry, a little bit of an education gap within certain populations that we need to make sure that there's still an understanding there. So even if the understanding is there simply to show the difference and to say, listen, this is a checking account at an FDIC-insured institution. Here's what that means, and here's why that's important. Versus here is something that I saw on Reddit or Twitter or something, and it sounds really cool, and people are talking about it, and that's great and that's awesome. That is an entirely different thing. And just being able to have that conversation, not only in an educated way but an authentic way, I think is really important. Sorry, I only went 3.5 minutes. Sorry.
Thank you. Doreen or Mark want to add anything to that? We've got 2 minutes left in our session.
Sultan did a great job.
I think he did.
Yeah.
Well, great. That's I think that's the end of our questions. So, panelists, thank you so much to Doreen, to Mark, to Sultan, and everyone listening. Thank you for your attention, and please be on the lookout for our evaluation that'll be coming via email. So, thank you all, and have a great rest of your day.
Thanks, everybody.
Bye.
Have a great 4th. See y'all later.